Hey, welcome. When most people hear the word accounting, they immediately think, complex math. But what if I told you that's not really the full picture? What if it's actually a language, the universal language of business? So let's dive in and learn the grammar that helps every single company on the planet tell its financial story.
Think about it for a second. Every single business has a story it needs to tell. Is it growing? Is it making a profit? Is it maybe in a little bit of trouble? It has to communicate all of this and do it clearly to investors, to banks, and even to its own team. So how on earth does it do that in a way everyone can understand?
Well, that's where accounting comes into play. It is the standardized language that turns all of a company's messy, day-to-day activities into a clear, consistent story. And because it has these set rules, anyone who speaks this language can understand the financial health of any business anywhere in the world. It's pretty powerful.
So how does this whole thing work? Let's start with a bird's eye view, a high-level map of the entire journey, from one single purchase all the way to that final report that an investor might be reading.
So get this, every single financial event, and I mean everything from buying a coffee for a client to closing a multi-million-dollar deal, follows these exact 5 steps. It always starts as a simple transaction. Then it gets recorded, classified, summarized, and finally, boom, it becomes part of the big story in those financial statements.
Now, what's really cool is that this entire massive system is built on one single, really elegant idea. Let's zoom in on this golden rule that makes the whole thing balance out so perfectly.
This right here? This is it. The core principle of everything. Every single financial event has 2 equal and opposite effects. You can't just get something of value without giving something of value up. And this simple idea, this concept of capturing both sides of the coin, is what makes the whole system so reliable and, frankly, so hard to cheat.
Okay, so to record these 2 sides, we use 2 words you probably heard before, debit and credit. Now, I need you to do me a favor. Forget everything you think those words mean. In the world of accounting, they are just directions. Seriously, debit just means left side. Credit just means right side. That's it. It's not about good or bad or plus or minus, just left and right. And this quote just nails the balancing act. For every single transaction, the total of the debits, all the left side entries, must exactly, perfectly equal the total of the credits, all the right side entries. This is the one unbreakable law that keeps the entire financial story consistent and totally accurate.
All right, so how do we actually apply this debit and credit rule in the real world? Well, there are 2 major methods, or you could think of them as 2 dialects of this language. Let's start with the first one, which we call the traditional approach.
This approach basically organizes every transaction into one of 3 buckets, one of 3 distinct categories. Let's break down what each of these real, personal, and nominal actually means. First up, we've got real accounts. Just think of these as all the tangible stuff, the assets and properties a company owns. The rule here is super simple. Debit what comes in and credit what goes out. So when the company buys a new laptop, that laptop is an asset that's coming in, so you debit the laptop account. But the cash you used to pay for it, another asset, is going out, so you credit the cash account. See? Both sides are captured perfectly.
Next up, we have personal accounts. These are all about tracking who you owe money to and who owes money to you. The rule is debit the receiver, credit the giver. So let's say you pay a supplier. That supplier is the receiver of your cash, so you debit their account. Your business was the giver of the cash, so your bank account gets credited. Simple as that.
And finally, we have nominal accounts. Think of these as the plot of your financial story. They track how well you're performing. The rule here is really straightforward. Debit all your expenses and losses, and credit all your incomes and gains. At the end of the day, this is how you figure out if the story has a happy ending, a profit, or, well, a not-so-happy one.
Okay, so that was the traditional dialect. Now let's learn the second major one, the modern approach. It organizes all the accounts in a slightly different way, but it's just as logical.
So the modern approach expands those 3 categories into 5, which you can see laid out right here. Now, it might look a little more complex at first glance, but don't worry, the underlying logic is exactly the same. It's just grouping things a bit differently.
This approach basically splits everything into 2 teams. On the first team, we have assets and expenses. For any account on this team, the rule is easy. To make it bigger, you debit it. To make it smaller, you credit it. And that makes sense, right? Getting more assets or having more expenses increases their balances.
And on the second team, we've got capital. That's the owner's investment. Liabilities, which is what you owe. And of course, revenues.
These guys work the exact opposite way. To increase their balances, you credit them. To decrease them, you debit them. The key thing to see here is that these two groups are perfect mirror images of each other. So now we have two totally different systems for applying the rules of debit and credit. We've got the traditional approach with its 3 golden rules, and we have the modern approach with its 2 groups. And this probably brings up a pretty obvious question.
Which one is the correct one? If you're learning this stuff for the first time, you're probably wondering which one you should be focusing on.
And the answer is, they both are. It's actually really cool. They are just 2 different ways of thinking that lead to the exact same result. It's like giving directions to the same place using different landmarks. The final journal entry, the actual record of the transaction, will be identical, no matter which path you decide to take to get there. So there you have it. That's the fundamental grammar of the language of business. You know that every transaction has 2 sides, and you now know 2 different, but equally valid ways to record them. The real question isn't about the rules anymore. The real question is, now that you can read the language, what stories of success, failure, or innovation will you uncover when you look at a company's financial statements?